Today we will be talking about that one item that has been associated with money, wealth, and power longer than anything else over time. What I'm describing is gold. Gold has always played an important role in history, and many people have gone and still go to extreme lengths to get their hands on this shiny piece of metal. When people hear the word gold, they will either think of gold in the form of jewelry or gold in the form of bullion, or in other words, gold as an investment. Now, why is it that gold is a metal that plays such an important role in society and not other metals? Well, gold happens to be rare enough where there isn't huge amounts of it floating around like copper, but it's not so rare like rhodium, where the annual production of rhodium is 1% of the production of gold. Also, gold will not rust over time the way iron does. And this is important because people wouldn't value coins and jewelry made of metals that rust away over time. Now, gold has had many uses over time, but one of the main uses of gold has been as a currency. And up until 1971, we were on a gold standard, where paper money was backed by gold. So every dollar you had could be traded for gold. But then in 1971, President Nixon announced the US will no longer follow the gold standard. But even since then, gold is still seen as a fundamental asset, and many people still see gold as a currency. Anywhere you look within the finance world, you will see different people make different arguments on why you should or shouldn't own gold. So in this video, we will answer the question if you should invest in gold. When it comes to assets, most will fall into one of the following categories: income producing assets, currencies, commodities, or collectibles. Now, gold does have industrial use for things like electronics, which is why it can be labeled as a commodity, but it doesn't fit into its category entirely because only 9% of the gold supply is used for this. Then we have collectibles, and because most of the gold supply is used for jewelry, it would fit into this category. However, when people talk about investing in gold, they normally refer to it as a tool to preserve wealth, or as an investment with hopes of profiting when the value increases. The way gold prices move is it tends to have a positive correlation with inflation, meaning the price of gold goes up with inflation, but gold has a negative correlation with the stock market. So whenever stocks are down, gold prices typically seem to increase. Now let's look at why some people say everyone should have some gold in their investment portfolio and other people say you shouldn't invest in gold. Those people who say you should own gold see it as a hedge against inflation, or in other words, as a way to preserve wealth. Over time, currencies like the US dollar tend to lose value as the central bank prints more money. And the reason they do this is to stimulate the economy, which is great, but just like anything else out there, the more there is of something, the less valuable it becomes. So now the more money the central bank prints, the less valuable each dollar becomes. So now it takes more dollars to buy the same items, and this is known as inflation. Just think about how much you could buy at the grocery store 10 years ago with $100 and how much those same items will cost you today. And that's how inflation works. And because the central bank can now print more gold the way it can with money, it makes gold a finite resource, meaning there's only so much of it out there. So investors who think inflation is going to rise faster than normal are going to put some of their money in gold so they can turn around and sell it for the new inflated price, thereby not losing purchasing power the way they would if they simply held cash. Now, the price of gold has outpaced inflation over the long term. However, it depends on what time period you're looking at. If you're looking at the price of gold between 1990 and 2000, the price of gold has actually decreased. But if you look at the price between 2001 and today, the price of gold has increased. Then another major reason investors like gold is it is considered a safe haven. And because gold prices are not correlated with the stock market, investors will typically move their money from stocks into gold whenever they worry about the economy. And then on the other hand, we have people who say gold is not a good investment and you should never invest in gold. Their logic is that gold is not an income producing asset and the same ounce of gold you have today will be the same ounce you will have in 10 years. Whereas assets like real estate and stocks produce income, which can be reinvested to buy more property and more stocks. Even Warren Buffett, who is commonly referred to as the greatest investor of all time, has said gold is not the best investment. He once said if you melted all the gold in the world into a cube, it would measure about 68 feet on every side, and it would be worth around 10 trillion. Then he went on to say the cube of gold will not produce anything in the next 100 years, or for that matter, in the next 1,000 years. And the cube of gold will not pay you interest nor dividends, and it will not grow its earnings over time. Then he said if you had $10 trillion sitting around, instead of buying all the gold in the world, you could buy all the farmland in America, which would cost you around $400 billion. Then you could buy 16 Exxon Mobils and you would still have another $1 trillion left over. Then over the next 100 years, the farmland and the ExxonMobils would produce trillions of dollars in revenue, and at the end of 100 years, you would still own all the farmland and ExxonMobils, at which point you should be able to sell them for way more than you bought them for. Then Buffett explains that for the cube of gold to be a better investment, you would have to be sure you could convince someone else the cube of gold is a good investment at the price you are asking, because that's the only way you could ever make money in gold. So that investment only makes sense if there's someone else out there who would be willing to buy it for more than you paid. Plus, you would have to take into account the cost of storage and insurance, and in the meantime, your farmland and ExxonMobils would continue to produce cash even when there isn't any buyers. Now, Warren Buffett does make some good points, but let's look at the numbers to see how gold performs as an investment. In March of 1980, the price of gold was about $1,770 once we account for inflation, and the day of filming this video, the price of gold is around $1,700. So in those 40 years, you actually lost money once we account for inflation. However, the price of the S&P 500 in March of 1980 was about $330 once we account for inflation, and the day of filming this video, the S&P 500 is over $3,900. So in the same 40 years, the S&P 500 has gone up around 1200%. Now, obviously, the rate of return depends on what time period you're looking at. In this example, we looked at the year 1980, which happened to be when the price of gold was at one of the highest prices ever recorded, and at the same time, the S&P 500 was still something pretty new, which is why the price was so low, and that's why we see such a drastic difference between the rate of return of gold and the S&P 500. However, if you look at the price of gold at the beginning of the year 2000, it was around $430 after we adjust for inflation, and now the price of gold is around $1,700. So during this time period, your annual growth rate of gold would be about 6.8%. Now let's look at how the S&P 500 performed over the same time period. At the beginning of the year 2000, the S&P 500 had a price of about $2,100 once we adjust for inflation, and at the time of filming this video, the S&P 500 is around $3,900. So over the past 20 years, the S&P 500 increased about 3% annually. So if you bought gold in 1980, then your investment wouldn't have provided you with any returns. But if you invested in gold at the beginning of 2000, then you would have been better off than investing in the S&P 500. And just for the hell of it, let's look at how gold investments would compare to equity investments from the year 2010 up until the beginning of 2021. At the beginning of 2010, the price of gold was around $1,300, and now it's around $1,700. So over the last 10 years, gold had an average annual return of about 2.5%. Now let's look at the return of the S&P 500 over the same time period. At the beginning of 2010, the S&P 500 was around $1,100, and now it's around $3,900, which means the annual return of the S&P 500 over the last 11 years is about 12%. So during this time period, you would have been better off investing in the stock market. What these calculations show us is that gold is a great investment during certain time periods, and during other times it can be a terrible investment. Now, in order to understand why this is true, we must understand what exactly causes the price of gold to increase or decrease. The biggest factors that affect the price of gold is supply, demand, and investor behavior. Since a majority of the gold supply is used for jewelry, the more demand there is for jewelry, the more the price increases, and that's pretty easy to understand because it's basic economics. But the other part of the equation that affects gold prices is investor behavior. And there are three major reasons why investors move their money into gold. And they are to use gold as a hedge, use gold as a safe haven, and then there's people who buy gold as a direct investment. When you hear people talking about using gold as a hedge, they are talking about using gold investments to help offset the losses of other investments or the decline of a currency like the US dollar. Then the next reason people invest in gold is as a safe haven during uncertain times. And this is why so many people bought gold during the financial crisis. And this explains why gold had higher returns than the S&P 500 during that time period. Whenever investors become scared or the stock market begins to lose money, investors sell their stock and move their money into gold. And the more people who do this, the more stocks drop and the more gold prices increase. And after a certain point, stocks become so cheap that people see it as a buying opportunity, and they take advantage of this. And once enough people do this, the price of stock begins to increase more than gold. And the third reason why people invest in gold is they buy it as a direct investment with hopes of buying it at a certain price, then selling it for a much higher price and profiting the difference. And their logic is that gold is a finite resource that has many uses, and because there's only so much gold in the world, the price of it is going to continue increasing. Now, whether or not you find any of these arguments logical is up to you, but just looking at the facts, it's obvious there's money to be made in gold. But just like any other investment out there, it all depends on timing. One of the main advantages of gold is there will always be a market for it, whether that's for jewelry or the production of electronic components. Gold has always played an important role throughout history, so the odds of gold becoming worthless are slim to none. However, the biggest disadvantage of investing in gold is that gold doesn't provide you with income, which I mentioned in the Warren Buffett example, and that's the main reason many people don't invest in gold. When you invest in gold, the only way you can make money is if the price goes up high enough to cover any costs you had in buying and holding it, and if the price remains flat or decreases, then you end up losing money and missing out on any gains. This isn't the case with investments like stocks and real estate because your returns not only depend on the investment going up in value, but you also receive income in the form of rent and dividends. If you own a piece of real estate, whether it's a farm or a retail center, that investment is going to provide you with income essentially forever, assuming you take care of it, so the price of that asset doesn't matter over the long term, which is not the case with gold because you only benefit once you sell it for a profit and not during the time of ownership. So now we ask the question of whether or not you should invest in gold, and the answer is it depends on what you're trying to accomplish. If you're looking to preserve wealth over time and your only two options are holding cash or holding gold, then owning gold would be the better option because cash will lose its buying power over time and gold tends to at least keep up with inflation. However, if you're looking to grow your net worth and earn income, then you're better off investing in other assets for the reasons I mentioned earlier. So with that being said, now you know why some people say you should invest in gold and why others say you shouldn't. And if you enjoyed watching or you found this information helpful, it would really help me if you like and subscribe. Thanks for watching, and I will see you next time.